Hello and welcome everyone to the Cash Rules podcast. My name is Keith Smith and I'm here with my co-host. He's the head of research. He's an educational program development specialist.
Fabyan Roldan. Hey, everybody. Welcome.
And we're here with our special guest, Kyle Hartman. I want to start off by making sure that we are all aware that none of what we are discussing today should be taken as legal, financial, and or tax advice. Instead, the objective of our conversation is to highlight some of the unspoken rules in finance, talk about why these concepts so often go unspoken, and what we can be doing on a practical level to change that reality in an informational and educational capacity. With that said, Fabyan, how are you doing today, man?
Blessed and highly favored. You know how it is. It's sunny outside. The sun came up. My grandmother always said, be happy that you woke up this morning. Others don't. And you have freedom.
No doubt about it. On my end, I am absolutely incredible. And I'm excited that we have a guest with us today. So thank you, Kyle. Thanks for being here.
No, thank you guys. Appreciate you having me.
Yes, thank you, Kyle, for being here. Appreciate you, definitely. I think you're going to bring a wealth of knowledge to our viewers and to ourselves.
Amazing. And so, yeah, Kyle, just to get started, tell us just a little tiny bit of a background about where you're based,
Sure.
A little bit of your history and what you're doing right now.
Sure. So I went to the University of Texas, graduated with an economics degree, worked in finance and advertising for 12-ish years. Saw it as not that interesting and wanted to do something more for the world. Took a brief sabbatical and then I joined Operation Hope, which is a nonprofit focused on teaching financial literacy in 38 of the 50 states here in America. And right now I work as a financial literacy coach.
Amazing. And so just to clarify, all of your thoughts today are technically separate, right, from what you're doing in your work there.
Yep.
But outside of that, I just want to go ahead and start getting into this. I know that you have a wealth of knowledge around economics and down all the way to the granular aspects of finance. So what I wanted to start off with is taking a second to really think about how to look at banking. Because I think pretty much everyone, right, interacts with banks, and the relationship that we have with banks is definitely changing in real time. But I wanted to get your perspective on, like, how do you view the banking system? How would you break down the difference between local banks, regional banks, national and federal level banking?
Yeah, and I think any understanding goes from the ground up. So we'll start with what you would call local banks. They generally have a fairly small amount of money in-house. They generally are focused on a certain vertical. So think of them being in a non-urban area. They focus on farming, or they are the only bank in that town. So those are local. So the vast majority, say 80% of their loans or 80% of their dollars are small business loans, checking accounts, savings account, whatever. Then you step up to essentially regional banks. So then you think of like Regions Bank down here in Texas, covers about 3 states. And then you start to see they have more money, they have more diverse interests, and it kind of scales from there. And then if you think of national banks, that is the big names that we all hear from Wall Street. That's the JP Morgans, the Bank of Americas. And a very small percentage of their business is checking and savings accounts, small business loans. We're talking million and billion dollar loan portfolios. And then all of them report into essentially the federal and or national banking system, which is a half private, half public entity, which I think is really something that we're going to discuss in the future here, but kind of a unique place that where the Fed falls. So that's kind of how you think of it. There are, I think, about 7,000 local banks, about 400 regionals, and maybe 20 to 40 nationals. So, start real low here, build up, pyramid. So that's kind of, if someone has interacted with a local bank, that's local, and then it kind of just scales from there.
Love it. And then one thing I realized when I phrased the question we haven't used this term yet, but when we talk about the Federal Reserve, right, bank, that is a central bank, correct?
Yes, it's a unique one. And I think this is going to be the biggest learning for a lot of folks. So the FOMC is also known as the Federal Open Market Committee, aka what you'll see in news articles, et cetera, as the Fed. The Fed straddles a line between being a private entity backed by six to eight of the largest banks, as well as policymakers on the public side. And the Fed then has their headquarters in DC, and then they have regional banks that make up governorships of their areas. There's one here in Dallas, Kansas City, San Francisco, et cetera. Or for anyone who's a currency fan, it's the little marker on your coin. It'll let you know where that mint came from and which Federal Reserve printed it.
That's awesome information, man. I mean, wow. I never thought about it in that sense, that you could actually find the answer in terms of where your mint is at based on just a coin. That's just, I feel like that's common knowledge, but I don't know how common it is.
Yeah, fair enough.
Love it. And then something that you've brought up already. So you have this system where there's all these different regional sort of hubs of the central banking system, as well as there are these key private players that actually have a say in sort of like some of the governance around the central banking system. What are some of the objectives of the central banking system?
Yeah, and I think this is another one that is going to surprise a lot of folks. The Fed actually only has two mandates. It's price stability and maximum employment. So when we say the Fed needs to do this or the Fed needs to do that, that's a lot of political blame game. I don't want to get anywhere near that in this sense, but they really only have two roles. And right now we're at maximum employment, price stability. I know we're going to touch on this later. Not so good on their report card. So at the end of the day, when they say the Fed needs to do that or this, it's not even in the scope of purview. So the Fed has got a very specific mandate, and we try to push those boundaries sometimes. And then people say, well, legally we can't. So it's a little bit of a wavering area.
Amazing. Thank you for talking about that. So price stability. How on earth can the central bank do anything about prices, and what is their role in that there?
Well, I think it starts with a tiny bit of history. The Fed doesn't even come about, and most of Americans fought federal oversight. We know Alexander Hamilton obviously was very popular in popular culture about us even establishing a bank. Jefferson wanted a non-centralized bank. It didn't start until right before World War I, so about 1912, 1913, to fund World War I. So it's a fairly new institution, and the way that it operates is that. But going back to this point is they have taken a basket of goods. So this is everything from eggs, milk, cheese, bread, gas, anything else that would fall in, like everyone is going to have this. This is everyone has some exposure to it. Oranges, peanuts, some amount of exposure. And then they've said, this is what it cost in this year. Okay. And that is what is known as the CPI, or the Consumer Price Index. It's 50 units, generally given that. Over time, some things have come in and out. For example, even though I'm born in Wisconsin, milk is no longer in there because our milk consumption has gone very far down. So this is an always evolving bucket of goods, so that the Fed can say, oh, the prices are going up too quickly, or very rare, almost impossible, the prices are going down. That does happen, but exception to the rule. So the Fed has really only two tools at its disposal for the common person. I know they have many more. Anyone's going to give you comments on that. I'm aware. But most of the time, it's about money supply and the interest rate. As you print more money, the interest rate drops. And the inverse, when you have less money, the interest rate goes up. It's more valuable. So when we started to print all of this money in response to the coronavirus pandemic in 2020, interest rates dropped, which means prices started to creep up. So now that we see a few years on, that's where we are. And that's why we have inflation to the degree we have today.
So there we go. That's the big buzzword of the past couple of years. Even in 2020, it started to come up. There was a lot of printing that happened, and due to a response to some of the emergency measures that needed to take place, and people were talking about inflation. Now it's in front of us. And last year, I think it was the big buzzword was that inflation is transitory, right? And
Yeah,
so
so let's
tell
talk
us, yeah, what's
about,
that?
yeah, so also, so we use someone's name that most people may see. Jerome Powell is the chairman of the Fed, and then there's the 12 Board of Regents that represent each one of the districts. Powell says famously about 18 months ago, oh, this is transitory in response to the coronavirus and us printing money. I will be as frank as I can without being demeaning. That any macroeconomic person would have said, no, you're behind the curve here, because these pieces of inflation were set into place years ago. This just put the match on the fire, or on the gas. That's all it was. It exacerbated a bunch of other issues. So although it would be deemed as transitory, we all knew this was coming. Or a lot of people in the economic circles and academic circles were like, we've seen this before. This will be a problem. But I'll address a thing that most people would ask, well, why didn't they raise rates earlier? It's a very delicate balance between getting the interest rate right and maximum employment, especially with COVID, where the unemployment numbers spiked. So they had to temper the scenario, and that's a hard thing to do. Do I think they could have done things earlier? Sure, but we can explore that on the next question.
So the next question, I'm actually going to back up a little bit because I want to make sure that we understand what are these interest rates that you referred to?
Yeah, so every year the Fed sets out a goal of what they want interest rates to be for that year. And they always give a 3 and a 5 year calendar as well. So, give you an idea, maybe they'll go up a little bit in 5 years, et cetera. Powell, in the most recent one, has said he aimed for the inflation interest rate to be at 2%. This is historically a good number where it gives you a little bit of money, but it keeps the economy moving. So there's a balance. So at this 2% rate, this effectively is what you can use as the federal funds rate. The federal funds rate is the rate by which one bank or one entity, that might be a little fancier term there because there are some weird pieces of this puzzle, loan to each other. So at the end of the day, bankers loan to each other at 2%. And then in whatever they do for you as a local customer, a national customer, et cetera, is based on how much risk they want to take on and how much money they want to take on.
And so to clarify, I want to make sure, because we have a lot of viewers that may not be familiar with the concepts of banks borrowing from one another and maybe even what interest really is, or the interest rate. So
Yeah.
when banks are, what does that relationship really look like?
So let's take a practical example. Let's say you have a local bank that has $10 million in loans. And they say, oh, well, we see a lot more of our customers coming in wanting more loans. Well, we don't have the capital. So we'll go to our regional or our national or federal partners and say, hey, we have more loans we'd like to give out. We're getting, let's say, 4% on them. The bank makes 2%. And obviously the bank pays the other party 2%, because the bank will charge you, the individual loaner, let's just say 4% to make the math easy. They make a little money, and then they pay another bank for some assets, money, collateral, commercial paper, but I'm not going to go too far there. And that's all that situation is someone lower down the food chain needs money, loans up and over, and continues on and so forth.
Love it. Love it. And so I think we've touched on this a little bit, but I want to make sure that we back up and cover it all. What exactly is inflation to you, and like what are the effects that is having on the business cycle and economics right now?
Yeah. Um, a little inflation is good, a lot is bad. You should naturally see price slowly climb over time. We get more efficient at producing goods. We have a larger marketplace. We have more goods we can sell. So things creep up naturally.
And these
You
and
start
this
to
is the
see
price of goods.
goods, strictly goods. Literally, what you pay for a dollar cheeseburger is still a dollar cheeseburger, right? Next year might be $1.10, but you go, okay, that's reasonable enough. It's going slowly in this direction. Versus anecdotal example, Taco Bell has changed their prices 4 times in the last 2 years. Something that was 89 cents is now $1.29. So when we talk about how this affects people, I like to start there versus the economy as a whole. This is very difficult for people who do not make a lot of money. Their out of pocket becomes more and more. We're talking about an increase on a Taco Bell taco of almost 40% in 18 months. Tacos stayed the same, but you're paying 40% more. So it's very difficult to underestimate how painful this is in an economy where we have some good employment, but a lot of poor individuals. That is just a tax. It's just slowly chipping away at whatever dollars they have. And it will be something that we have to deal with in the future.
I'm happy that you touched on the point of just food, right? I mean, when we talk about food, when we talk about inflation, we talk about money. How do you survive is by paying rent, having a roof over your head, or consuming the nutritional resources that you need, right? And that was a great point that you made in terms of the 40 cents. It could go up 40%, 40 cents, no matter what. 40 cents, 10 cents, 5 cents to the most lower class, to those who need it underneath the poverty line. That's a lot. That can mean a lot. That could break the bank for most people. That can be a decision of whether or not to pay a bill or, feed your kids.
Yeah, and Fabian, I think what's even more alarming there is that you brought up something else is rent. Real estate in its entirety essentially makes up about 25% of the basket of goods and inflation. So we've also seen that rent has started to creep, and that's a bigger number because we're not talking about tacos, maybe one, not two. Yeah, you're a little hungry, whatever. But to somewhere to live, we're talking about the fact that 40% change in 2 years. I mean, rent is astronomical at this point. And then you have the decision of, do we stay? Do we go? How do we find new employment? And I think those things are going to be a much harder and more real thing that we have to deal with today. The rest of inflation, we'll see as it hopefully tempers out, but that'll be a big one in the near future over the next 6 to 12 months. So,
and that being said, what can the average person or investor do with this kind of economic data?
Sure. I wish I had something very constructive, or I wish I had some cure-all. I would have called Jerome Powell recently and given him that answer. But I don't. I think for most people, let's start with the average person, it is finding ways to make more money. And I hate how simple and unfortunate that answer is, because as inflation continues to go, it will be that way. Investors, if you do have assets that are significant enough, you have to either say, do I have a long-term goal? Because equity markets are still the best performing asset class for the 150 years. And then 2, in the short term, is the decision between how much money you want to have as risk, essentially in the equities market, and look into either bond markets, real estate, or good old fashioned cash in the bank, and make decisions when they start to present themselves. None of those are going to be groundbreaking, but right now I don't see a near-term fix for a lot of these problems. So I wish I had that answer.
So I want to tap in on the fact that just recently this week, it's currently September 22nd. And so yesterday on the 21st, Jerome Powell and the Federal Open Market Committee had their meeting where they come together and they tell us a little bit about how the economy is doing in their response to the economy. So yesterday, we had the announcement of a 75 basis point rate hike, which I believe is the third 75 basis point raise in a row now. And what does that mean exactly? And then how do people stay on top of what the Federal Reserve is doing?
Sure. Well, first, it's always live on YouTube on the free channel. So in case you ever want to watch the exact words they're using or see how the room reacts, that's available. In terms of what that means, it means the new federal fund rates is already at 3.25. That's with the latest hike. So that means everything in the loan portfolio got a little more expensive. I'll give it another more basic example for a lot of folks. The new mortgage rates are now over 6%, when only 2 years ago, if you had perfect credit, you were almost at 3. And we're talking about that will be compounding over a 30-year period. So when you buy a house today, you will be paying almost twice the amount of interest over the life of that loan because of the inflation that has happened over the last 18 to 24 months. My only statement about this is retroactive. They knew this was going to be a problem. They continue to say it's transitory, but we saw the pieces of the puzzle starting to fall into place, and they should have made smaller hikes earlier. But at this point, it is what it is. I expect, so they meet 8 times a year. I think the next one's October, maybe it's November. I expect probably another healthy one again for this year to try to keep the price stability in check, but we'll have to see the jobs report. We'll see what that's doing in terms of the economy. Did this actually functionally change jobs, roles, money being brought into households? Or did it just affect equity markets? Don't get me wrong, equity markets are important, but operationally, only 10% of the US really operates in the equities market. Everyone has a household.
Love it. Love it. And something I just want to touch on here, because for anyone who was around for 2008, 2009, I was very out of the loop at that time. We had a global sort of phenomenon that took place during that recessionary period. And so right now we're seeing some things that are a little bit similar, I would say, where countries and regions around the world are having to react to and maybe even try to get ahead of what the Federal Reserve is doing in these meetings. And so Christine Lagarde, the head of the European Central Bank, actually, I guess a couple of weeks ago now, maybe a few weeks now, she actually went ahead and did a 100 basis point raise at the European Central Bank to try to get ahead of the Fed's decisions. And I just wanted to point that out, that there are also ways to kind of think about what's happening on a global scale and looking at what other central banks are doing to potentially get an idea of like where people's heads are, where their mindsets are around what's coming next for the Fed, or just really sentiment around like what it is that's happening. So I just want to throw that out there.
And I think the part that should be concerning for people on a more local normalized scale is because this is happening in Europe, this is happening in Asia, this is happening in Africa, that means all of their raw input goods are going up, which means they get shipped over. So we're also on the tail end. There's something I like to watch more than the CPI, and this may be a little bit above our conversation for the idea, but it's called the Producers Price Index. It's how much does it cost to produce something, not what the consumer ends up paying in the end. That's the CPI. The PPI is always a leading indicator. And as we've watched the PPI continue to creep, and that will always mean more costs for you to get that, there's going to be another probably high price. It's going to be $1.39 for the taco. And it just continues to go that way because the people who are producing the goods not only are anticipating, but their goods became more expensive. So we're nowhere near the end of this. I would love to say something positive and rosy, but this is going to be a real thing for at least 6 to 12 months. And I think you're parallel to 2008. Pretty fair.
Now, let me ask you a question. There's two basic questions. One, now you did say with the report that just came out that was on YouTube, you mentioned reactions. Why is it so important to study the reactions in the room of that report?
I think you can read something or you can watch something. And last I checked, our newspaper circulation is down, but our internet video usage is up. I think there's not exactly a key takeaway, but see, how does that room react and go, that seems about fair, or that wasn't enough, or ooh, that's too high. And the general sentiment can't be written down. It's not something that really translates to the page, but more so about on video, you're able to say, hey, well, the room seemed a little shocked there, because the big rumor was it was only gonna be 50, but it was also a lot of rumors about 75. So half that room was probably a little like, that's a little higher than I expected. Nothing concrete, but just general perception.
Interesting. And then what about the in terms of downplaying? We hear that all the time. How the Fed is downplaying or the ECB is downplaying a recession talk or a recession idea. What do you have to say to that? And what does that mean to somebody who doesn't know what that means, like doesn't understand that, isn't connecting?
Yeah. Well, factually, they have been downplaying it. A recession is when your gross domestic product, or all the goods and services in your country, has been negative for 2 quarters. That has been true. So when we talk about downplaying, the historical and book definition of a recession is 2 quarters of negative GDP, gross domestic products and services, negative. I also believe it's a little bit, and maybe this is a little brash for a podcast, but you don't want the party to end. It's 2:00, you don't want to go home. We just want another hour. We want another 2 hours. We don't want to think about how bad we're going to feel tomorrow. But when you keep doing that, sooner or later, you start to buck up against, oh, it's 4 a.m. I really should have went home. Oh, it's 6 a.m. I definitely should have gone. And that's the problem, is sooner or later, you have to be like, yeah, I probably should. And that conversation should have happened, with your friends in this ridiculous example, 2 hours ago, and been like, hey, it's getting pretty late. We probably need to make a decision. May not be as fun, but it is what we've done. We've overstayed the welcome of the free money, the fairly good economy post-COVID, and now we're seeing what that costs tomorrow. What is that going to be for us tomorrow? You don't want to admit you made a mistake, especially in anything in a public office. So they downplay it as much as they can. I understand that, but that's more or less the truth of it. No other agenda there other than just the facts of what you define a recession as. And
so it kind of makes sense what you're saying, right? Is that, they downplay it for 2 things. One, the scarcity of a recession, right? That actually playing out. And then 2, obviously, votes. These individuals, these politicians are out there to, soothe the voters, calm any quarrels and any type of situation to make sure that they continue to vote for them. That makes sense.
Yeah. And without going to either side of it, I think the bigger question will be is, what is the cost of the decisions we make today versus our lives and tomorrow? And not just in a strictly lens of that, but you're saying, well, I want to have fun today, but maybe I'll eat the cheeseburger. I won't go work out. Sooner or later that catches up with you. And when you're right near the end of it and you're like, ooh, I have to go to my doctor's physical this year. And you're like, ooh, I should have done something. We're right there. November elections are 60 days away. And they kind of want to just be like, we'll just push the doctor for like a month or 2 and we'll go in January. And that's just not possible. So that seems to be the most likely scenario that we're going for. And as you said, it's a really scary word. And I would not be shocked if you find a new term for it coming out soon.
Ooh, interesting. New term. Something to blindside us.
Wow. So I want to touch on something because, Kyle, you talked a little bit about how the warning signs have kind of been there and how this has been the slow turning around effect. And what I just did some research, And technically, the Dow Jones Industrial Average actually reached a new peak for the last time in January of 2022. All right. There's been one big thing that has happened since then, right? Which has been, I believe, the beginning of the Russian-Ukrainian war. But besides that, I think a lot of these things were already clear. A lot of what was happening in the economy was already clear. So tell us a little bit about how you interpret the fact that the Dow Jones, NASDAQ, S&P had been rallying to all-time highs all the way up until that moment.
So there are two things I'd like to say, and this I will admittedly say is the soundbite you need to use. The stock market is not the economy. And I think that is a very common misnomer because, as I said earlier, only 10% of the US is really in equity markets, and most of them through very passive retirement accounts, IRAs. There aren't a lot of people who really look at the S&P and go, wow, great day, up 2%. What a wonderful day. They're going, I'm paying twice the amount of money for my taco. So that's my first statement. The second one is when you see that inflation and these other things are coming up, the only way to outpace them, the only asset class that was going well was stocks. So they had nowhere else to turn. Bonds were not doing well. Real estate, although hot, is something that takes a little bit of time to get into. Stocks and equities, I can trade in 2 to 3 days. So they were saying there's free money in this system. We still need to outpace it so that we can hit our quarterly goals, our annual goals, our monetary goals. And that's where they went. I'm not shocked to see it. And I'm also not shocked to see the downturn that's happened over the last 180 days. And also just for everyone listening, the Dow Jones is the 40 largest companies in the United States. It's not the S&P. The S&P is the 500 largest companies in the United States.
Thank you for that. Thank you for clarifying. Yeah, these large indices are what like make headlines all the time around like, oh, this is how the economy, you do see people referring to these ways of looking at how the economy is doing. But I love your clarification of like, this is not exactly the reality. These are even potentially lagging indicators of like what's happening. If you really wanted to look at the real data, look at the CPI, look at the PPI, and dig into some of that stuff. So that's actually my next question too. Where do you go to stay on top of important dates and all of this economic data?
Yeah, so I think the first one is there isn't a centralized location that I use. I really rely on publications that fall as close as possible to the middle so that I get just the factual information versus an opinion or bias. And I'm not endorsing these people, but I like The Economist, Financial Times, Wall Street Journal. A lot of these also are free at your local library. They have access points so that you can go and see them because they generally are paid publications and see what numbers are coming out of there. Because those are, frankly, sometimes a little boring to read, but the numbers are the numbers and there's not but this or that. And then on top of that, it is, frankly, just continuously working on. Now that I know about the CPI, I need to go look more. And that means Wikipedia, Investopedia, any place that you have access to learn more will be your only avenue to learn more. It is a closely protected secret. As we said earlier, you can use very fancy terminology and words and acronyms to throw people off. So there aren't a lot of times easy access, but the Fed.gov site does publish everything. And then, as I said, the Fed also has a YouTube channel, but those are only 8 times a year. The work of financial literacy is every day.
I love that. And I'm glad you brought this. You going into financial literacy, you talk about education. One of my key backgrounds is education, where I perform and provide programs centered around financial literacy, education, academics, anything to that nature. And it's funny, we talk about the Fed so much. One of my schools that I actually oversee was part of the high school Fed challenge and actually one of the finalists. So if you ever get a chance to look at that, the Journal of Future Economists, I'm sorry, they were actually on there. And this what brings me up to my question. When should educators be teaching about financial literacy? What age, time, etc.?
Yeah. I won't use the piggy bank example because I don't think that's relevant and it's pretty antiquated. I would generally say that this time you start going to high school, when you're 14, 13, 15, matter upon what year you fall into, that's when I think you need to have for lack of a better term, an option, extracurricular, any of those things that are available. Any of those would be better, just so you can say, here's what a checking account is. Here's what a T-chart is, which I tell most people is just nothing more than saying assets, what you have, liabilities, what you owe. You basically add them all up along the way and go, do I have more or do I owe more? Ooh, I owe more. I got to figure out a way to address this. Those simple steps start the idea that money is not something that doesn't exist. We continuously talk about the fact that we give 18-year-olds credit cards, $100,000 to go to college. You have to understand where that starts from. And I think it starts at 14 or the first year of high school. And then hopefully by the time you get to your last year of high school, when you see your federal loan package, or you may have to take out private loans, you are at least a better educated person, and you hope that someone else can be there and help you. And I think that's going to be a new stage, and I hope it sees some sort of widespread adoption.
So mentoring is basically what you're trying to see in terms of that. That's a big thing in terms of mentoring. How do you feel? How did you start off with a mentor in terms of your education, your road?
I was very lucky. I went to a very nice high school, private high school in Wisconsin at Marquette High. And I was lucky enough that we had essentially an basic economics class freshman year, all the way up into AP classes by senior year. So it's kind of a funny anecdote. Every Friday, we would just read some of the Wall Street Journal. It was just to be like, here's what's going on in the world. And you could ask the teacher, well, what does this mean? What is this number, say? What is a price to earnings ratio, or a price to sales, or EPS? Because there are so many of those things in there that are thrown quickly at you. The ability to understand them, interpret them, and then use them in your own life. I was lucky. I was very lucky. And I think that's why I think 14 to 18 is a crucial time period.
It's funny that you say that. I think I said this in past tapings and past interviews, that not a lot of high schools provide such education like that, financial literacy, period. Anything around stocks, the market. You go to, especially taking New York, for instance, you have specialized high schools, business or high schools that actually provide those classes, unlike others. You'll probably have that maybe 10% of the entire spectrum of, let's say, New York City, but everybody else won't even get a chance to touch on it. So then now when it comes down to financial literacy, as you're stating, it gets harder, in terms of understanding and even connecting with it.
And I also don't put any burden, and I don't think either of us said this, but I don't put any of it on the schools. I wish it just existed as an addition to, because they're already not having enough resources to teach math, which you'll need in financial literacy. That we have a dwindling arts programs, that you can also explore other aspects of your life. Yes, financial literacy is a core component of the average person in America, but teachers and public school, it's going to be on their docket for 10 years. I wish it would be, but I don't think so.
So you're saying it shouldn't end or even start in school? Is that what you're saying?
No, I totally agree that it should be like every part of it. It should be either someone is after school, extracurriculars, anything of that nature. And it will take people like Operation Hope and saying, we have to step in earlier, because a number of the times that I've had clients come in, they're just so overwhelmed, with interest and debt that it's kind of too late. And I don't want to be bleak about that, but you're just basically working out of a debt hole for the next 10 years of your life. when if I could have given them a little bit more advice earlier, I'd be like, credit cards have to actually get paid back. And that idea sometimes is foreign to people. Like, well, it just goes on the credit card, right? True, but we just didn't give them enough information along the way so they could understand, I will have to pay that someday. But yeah, I don't think it falls directly on schools. I think it falls on a community. I think it falls on nonprofits. I think it falls on, more and more of America to fall on it. But the schools would help, but I just don't see it being a high priority for them.
So how important is college then to someone looking into probably studying stocks or even anything crypto related or any of the nature?
Sure. I'm not the biggest proponent of college. I think that we have got you should always be pursuing more education. You should always be trying to be a better version of yourself. However, there are excellent trade colleges. There are excellent community colleges. The idea that we need to go to a four-year college and buy a house in the suburbs, that may be a very nice notion, but it's not as applicable. For example, I know for a fact that in Dallas, a plumber can roughly make about $70,000 a year for the next 30 years. They can be in and out of trade school for $6,000 in 1 year. If you like working with your hands, don't go to college, go to trade school. You have a great job. You know how to do things. You're self-sufficient. I think we need to have a better understanding of what higher education means and what a four-year college should entail. But if you're strictly looking at business, yeah, four-year colleges are pretty much your only real option.
And just to piggyback on that, what do you say to someone, or what do you provide to someone who's interested in studying more about this field, right? And they see it as monstrous or even boring. Sure. What do you say? What do you kind of get at?
Yeah, so I think you have to find the person who makes it entertaining. I was lucky enough, and one of the questions you guys threw my way, I love Malcolm Gladwell. He's just the coolest guy in the room. Every story he tells is engaging. It's finding someone who gives you some sort of fun way to look at finance, because trust me, reading the Financial Times, reading the Wall Street Journal, there is no color there. There's no fun. All right. So really it's about finding those people, if it's on YouTube, if it's on podcasts, someone you enjoy listening to talk and tell these stories to help educate you, are the only ways I see it. I don't think a 14-year-old is going to pick up the Financial Times and have a great time.
Not at all. I don't think so either. On you, Keith.
Okay, good point. Yeah. So I do want to transition us a little bit here because we're getting close to the end of time. And I just want to thank you, Kyle, for everything. But before we do transition to the very end, I know that you have some interesting thoughts around how technology is having a big impact on the financial system, the banking system in general. I just wanted to kind of give you a second to talk a little bit about your thoughts there.
Yeah. So, the modern banking system was more or less in the United States developed around the 1870s. Because if I wanted horses in California, but I had to get them to Philadelphia, there had to be a way that I could give you money, which then at that point was a check, to pay for those goods. And there had to be an intermediary in those scenarios. Given the development of technology, the role of banks and banking, in my opinion, should be so heavily decreased. We have so many avenues by which we could operate our own systems. I could Venmo you right now. Now, don't get me wrong, there's a payment agent, there's money that's transacted, etc. But I don't even use a bank anymore. It's a balance that I have on another app, that I can send to someone. So I see the more technology we get, the more we're going to be able to ask of banks or decrease their position and ability to dictate a lot more of American lives. I see it as a really good revolution for the average consumer. I see it as a tough time for Wall Street.
And then, so what are some of the specific things that you see?
Yeah, so I think the biggest one is, let's say, Keith, you loan me $500, but I put up the collateral of my car. We don't need an intermediary in this new world that we may be coming towards. The decentralization of finance is about the same functionality without a third party in the middle, or putting it more blankly, that banks just don't have the role that they used to. So as we start to do these smaller micro transactions, we start to do loans of some significant amount, the more adoption and the more time we do that, we give more and more credence to the system. We wait for technology to catch up. There's obviously a really huge opportunity for blockchain. I know that's not a long conversation we can have today, but being able to say, my car lease is on the blockchain, which means that it is forever mine as long as I hold it, right? But if I sell it to you, well, we don't even need a bank. I just transfer you the title on the blockchain. That's it. There's no intermediary of those two scenarios. Do I think that's futuristic and a little bit further down the road? Sure, but it gets closer every day. And if there's anything we've always been told, technology is a lot faster than you give it credit.
Love it. Love it so much. Thank you for breaking that down for us. I think now we're going to transition into the final segment of the podcast. Fabyan, is it time? You're on mute.
Are you ready? It's that time, baby. It's that time. It's that time. That wrap it around. Let's get it done.
So Kyle, we're just going to ask you a few questions. Just want to get the first thing that kind of comes to your mind and just, tell us what you think. So first, are you ready?
Shoot.
Okay, cool. What is money?
A way to transfer goods and services.
Love it. And then this one's much easier. Don't worry. What is your favorite book?
Oh, Fantasyland by Kurt Anderson. I don't want to extrapolate. I know we don't have much time. Huge.
No, tell me, what is it about?
So Fantasyland, it speaks a little bit of America. It's about how Americans, we always believe that we're supposed to be rich. In the 1600s, we were supposed to find the passage west. In the 1800s, we were supposed to find gold in those hills. In the 2000s, we were supposed to make money as snake oil salesmen. We're just always been this way. Whether or not we like it, that's how we're wired.
Love it. And then now tell us, Kyle, do you have a favorite podcast that you listen to?
Yeah, I mentioned earlier, Revisionist History from Malcolm Gladwell is my go-to. I love every single one. He's a master storyteller.
Heard. Fabyan, you got
Let's not forget about this podcast right here.
Oh, well, now Cash Rules is up there. You're number 2.
Oh, that's that Cash Rules. Everything around me.
And Kyle, tell everyone, because they're definitely going to want to hear more from you. Where can our viewers get in touch with you?
Yeah, I'll be sure to give you guys details. I'm based in Dallas. I still work out of the Operation Hope office on the Elm and Main downtown. Other than that, I'm always available. LinkedIn, Yahoo, whatever kind of social media is available. But yeah, other than that, I'm happy to go any medium that I think exists today. There's a lot of them.
Too many. Thanks again, Kyle. We really appreciate it, man. And we're really looking forward to getting this out to the viewers. So thanks a ton.
No, thank you so much for having me. Hope you guys have a great day.
No, this was awesome. I appreciate you. I know Keith does. I know our viewers do. You did exactly what you said you was going to do. And that's what this podcast is about. Bringing people on. They said they're going to provide information, provide those resources, provide that battery on the back to get this moving and understanding how influential you are as an individual. Thank you so much, Kyle. And thank you for providing us with such great information. I think that our viewers, Keith and I, we're going to be using your information up. We're going to be making moves, making sure that financial literacy is out there for everyone. Thank you for being part of this broadcast today. Keith, tell me about yourself.
Man, I think that really does it. You really encapsulated everything that I had to say. So, hey, have an incredible rest of your day. I definitely will.
Oh, sure we will. Hey, when the sun is greener, the money's there.